The next concept that we are going to discuss here is about what is cost of capital. So, in the later section we just in the last section we just discussed with regard to sources of financing and also with regard to what do you mean by debt and equity and all. The cost of, now it is a cost of capital, that is after raising of sources of fund, how do we manage the cost that has been incurred based on the risk and return aspects that is in the combination of debt and equity. We also discuss, we just know about what is the opportunity cost of fund that has been used to evaluate the investment opportunities. The major purpose of the cost of capital is to know about the framing, the company has to make an investment decision. It helps to, the importance of cost of capital is to make an investment decision and also to create a debt policy, and how the cost, that is both debt and equity, plays a major role. So, here the meaning of the cost of capital is refers to the rate of return required by the investor to compensate them for the risk of investing in a company equity or debt securities. It represents the opportunity cost of fund and it is used to evaluate the attractiveness of investment opportunity. When we talk about an opportunity cost, think that if I have 1000 rupees, if you have an 1000 rupees savings, suppose if you want to invest in an nationalized bank for 7% of interest or an post office certificate for an 6.5% of interest. So, these are the two opportunities available for me. So, I decide to invest in an I think about, before investing I think about which are these banks, both are nationalized bank, one national bank and postal certificate, both are government based bank and the risk factor is bit low. So, I would tend to invest in 6.5% wherein of interest rate rather than going for an 7%, it is my wish, it is my interest. So, that as when we compared with thinking of investment of 1000 in a national bank deposit or 6.5% in postal certificates, I decide upon investing on a postal certificate, that is investing 1000 rupees on 6.5% of interest rate. Okay. So, these are the two opportunities available for me. Out of these I forego of investing on 7% interest rate, and that is called as an opportunity cost. That opportunity is we will be investing on two aspects, that is for a 7% interest rate or a 6.5% interest rate. Out of these I forego an opportunity to invest on 7%, rather I invest in 6.5%, and that would be called as an that is opportunity cost of capital. It may be of interest rate increase or decrease, whichever the alternative solution, alternative course of investment I choose, I decide to choose, would be the core meaning would be called as a opportunity cost of capital. It does not mean that it is on, should be why did you decided to invest only on 6.5, which is 5% less, that is my decision. I am not thinking about increase and decrease, both are government based bonds, both have got an opportunity to invest. I have got an opportunity, I can invest on 7% also or 6.5, but I chose to invest on a 6.5%. So, I forego an opportunity of investing in other alternative would be referred as an opportunity cost of fund, and it is used to evaluate the attractiveness of an investment opportunity. So, here when we talk about cost of capital, we think about cost of equity and cost of debt. The cost of equity would be termed with regard to an equity shares, preference shares, where equity shares is being represented as KE. Okay. Preference shares is being represented as, cost is represented with the term K, where KE, KP represents the cost of preference share and the cost of RE, that means retained earnings. So, these are the three major concepts that would be considered in an equity, but all the three are a combination for payment of a dividend. So, what is a percent cost that has been referred for the payment of a dividend. When we think about debt securities, it can be in term loans, it can be in debenture, it can be in bond, but all these ends up with KD, that is cost of debt. Based on these cost cost implication, we just know about the cost of capital. What are the components? That is what we discussed: cost of debt, cost of equity, weighted average cost of capital. that means the proportionate of investment made between debt and equity. Okay. Let us discuss with regard to what does a cost of debt is all about. The cost of debt represents the interest rate of a company pays on its debt obligations such as loans, bonds and other debt instrument. It is influenced by factors such as prevailing interest rate, credit worthiness of the company and terms of the debt. That is, a cost of debt is a debt, when we call about a debt, it is a repayment of interest. So, when we think about in time value of money, we just think about compound interest and a simple interest, and also that is we just discussed with regard to payment of interest rate. We took it a combination of time value of money, that is time that has been taken to see the future, what is the present value and what is a future value. Here also we just take cost of debt that has been incurred, how much is the capital that has been raised out of debt would be known here. Next is in cost of equity. The cost of equity reflects the return required by shareholders for investing in the company's common stock. It is determined by the factors such as company's risk profile, growth prospects and market condition. Definitely here also cost of equity, it's a, we do treat it as a owner of a company or a member of a company. So here or a retained earnings would be treated. So based on that, it is what are the factors such as common risk profile. Here we just think about risk profile over here, and also growth prospect and a market conditions of a thing. So when we talk about weighted average cost of capital, average represent mean. Okay. The weighted average cost of capital is blended cost of capital that reflects proportionate weights of debt and equity in a company's capital structure. It calculated as the weighted average cost of debt and cost of equity adjusted for tax. Is what is that adjusted for tax? Debt tax will be considered, for equity there is no tax. For the interest whatever we pay, the tax will be incurred. Based on the tax, that is the debt will be, the debt obligation will be made. The proportionate of whether it is a 40% of debt, 60% of equity, whether it is a 10% of debt and 80% or 90% of equity, based on what is the proportionate, out of which whether we have been raising with an equity, how much is with the own common stock, how much with the preferred stock, how much with the retained earnings, or when we are going with an debt, whether it is for term loan, bonds or a debenture. So these are the basic three components of cost of capital, that is cost of equity, cost of debt and weighted average cost of capital, that is overall average, that is the mean value that has been represented to carry out the total average mean that will be reflected. The next one, what are the factors that will be influencing on cost of capital? We may call it as the size of an organization, nature of organization, growth of an organization. When we try to see what are the factors that can influence of cost of capital. First one is in market condition. What is a market condition? How do we, as we are exposed to an external factors, so market, that is interest rate fluctuation, impact borrowing cost and high rates of increase the cost of debt financing, and inflation, that is the interest rate. The interest rate purely depends upon the impact of borrowing cost, that is with the market rate prevailing to decide what is the total interest that is interest has to be paid. And the inflation, as I told you that inflation influence debt and equity cost also. Higher expectation lead to high rates of inflation, and investor sentiments, that is affects equity cost, optimizes, reduces required rate of return. That is when we talk about market condition, market in the sense it is an external factor. It is an external factor where we are exposed to an external contribution, that is interest rate. It will be not in our control to reduce the interest rate, but of course it is been based on the based on the obligations that we have, based on the what is prevailing price, based on that we can decide and we can fix up the interest rate. Rather we can't go and fix the interest rate. Yes, what does the inflation? Inflation, rupee value decreases, product value increases. That is what inflation is all about. Suppose if I have 1000 rupees, if I can buy 10 kgs of rice in 1000 rupees today, tomorrow the kg of rice increases by 110, I cannot afford to pay only lesser, not 10 kg, less than 10 kg. That means product value increases, I am sorry, yeah, product value increases, price of a rupee decreases. That cannot, even that is not in our hand to control that. So even that has been also been influenced with the debt and equity cost, and if we expect high and return higher rates. And investor sentiment, as I am an investor, always thinks about an equity cost, whether what is an, as I discussed with regard to what is an opportunity that has been I have in right in hand. If I think about a return factor, I always think about a return factor also. Return factor and the risk and returns go in and hand in hand. And when we diversifying of it always reduces the risk, and it always optimizes the required rate of return. Second one is company specific factor. Company specific factor about what does a company is all about, whether it is a manufacturing company or it's a service oriented company. When we think about company specific factor, for example, a COVID time, the complete shutdown of a manufacturing company, but service oriented industries like especially in a pharmaceutical industry, it was a boom. It was in a boom. IT industry, it took into a very drastic change wasn't happened, isn't it? That is a company specific factor. So risk profile of a company, high risk increases cost, industry volatility and leverage impact also plays a major role with regard to an company specific factor, that is risk profile of a company. So there are risk profile always tends to see that what does a company is all about, what is a, when we are raising a capital through an initial public offerings, we just see where does our investment has been going to get invested. When they give issue and prospectives, in a prospective which gives a detailed information about vision, mission and objective of our company. Vision represent what are we going to do in the future, mission what is the infrastructure right now we have to attain those future, and our objective right now what is our main motto. So objective leads to, helps to achieve the mission, mission leads to achieve the vision of a company. So these are all the factors which directly or indirectly impact on a risk profile. The growth prospects. The growth prospects are the growth prospectus, definitely we do not think about of a company for only for running for 1 year, 2 year or 3 year. We always focus about a future. When we make an investment decision or financing decision or a dividend decision, whatever the cost decision that we made, make it for a longer period, thinking about the future in mind, there will be a strong growth and with the lower cost. And investor accept lower return for growth, definitely. If you are not able to give a good dividend, instead of that if you are able to see, the investor can see the good capital gain. So definitely it is in a drastic impact on shareholders, there your motto will be served, that is giving an importance with the shareholders wealth maximization. So where shareholders will wealth maximization not only in terms of returns but dividends, but also in terms of capital gain, where completely they will take in have a positive note with regard to and getting in a good rate of return in the future. And the financial stability of a company, okay, stability of a finance, if the company has got a good stability of finance, definitely the cost will be reduced. That means if the borrowed fund will be lesser. If the company stability company do not have stability over its finance, definitely the borrowed finance will be increasing. Higher credit rating, lower borrowing cost. Definitely the higher credit rating, in the sense the more we generate fund, the more we acquire fund, in the both in the debt and equity concept, definitely the cost will be always reduced. Third one is capital structure, that is what is a debt and equity ratio. We cannot raise the fund sources of finance only through equity, it will hamper your profit because tax cost will be increasing. Or we cannot raise only through debt, because debt is a one would want to protect cost, but whether you earn profit, when you company is under loss, debt has to be repaid in terms of committed interest that you will go. So debt to equity ratio mix affects overall cost, that is debt and equity. Always debt should be 1, equity should be 2, so that 1:2 ratio will be always, we always try to explain those concepts, with the debt should be 1 and equity should 2, so meet the obligations of the company. A higher leverage raises risk and cost, definitely the higher capital structure combination will be always having a higher risk and higher risk. When we come across with the another concept called weighted average cost of capital, we just try to see overall cost. we just try to focus on overall cost. What is overall cost is all about? The proportionate of debt and combination of equity. Okay, what is the cost of equity? What is the cost of debt? That is the overall cost. Put it together, we will get it as an average, where we are going to solve problem based on this, that is cost of equity, cost of debt and cost of weighted average cost of capital. Under equity we have got dividend discount model and CAPM, capital asset pricing model, and also under debt we have got redeemable debentures, irredeemable debentures. Based on the various combination we can be further moved on. Next, regulatory environment. Regulatory environment, what are the rules and norms, regulations that has been framed by an organization, that is taxation policy, that is tax intensive affects the debt cost and deduction of lower effective cost, and the regulatory requirements are compliance impact cost and standard influence financing cost. That is, when we think about regulatory environment, that is a rules and regulation that has been framed by an organization. The taxation policy, that is whether it is an advance tax, whether it is an interim tax or it's an annual tax. Whatever the tax that has been, it is always affect the debt cost, that is tax incentive affect debt cost. And also when we are paying a tax, the debt monetization will be done, which will be always having a lower cost. When that is a compliance that is impact cost is always been with regard to in a payment mode, that is payment that been made between the investor and the borrower and the investor. And when we have a standard investment plan, definitely it is going to get the betterment, that is based on the credit worthiness, that is if you want further raising further increase in debt factor, we definitely focus on CRISIL rating. That is, I want a personal loan, if my payment, if I have taken a loan earlier, my CIBIL rating will be higher. If I have not taken any loan, the initial loans will be, this is my fresh loan application from right from 20 years of my service. If I am applying for a loan right now, it is my till now in my CIBIL rating will be low. That means credit worthiness should be increased, the money transaction should be happen. That is what the standard influence of a financing cost. The fifth one is market perception. Reputation of your company, we call it as in goodwill. Brand image of a company, a strong brand will always we think about. Okay. So market perception plays a major role with also is one of the factor for the cost of capital. That is, market perceptions may be of a management quality and brand image and reputation. That is, strong brands reduce cost and perceived as a lower risk. That is, brand has a value. Brand has got own value. As the brand has got own value, the cost of implementation will be for producing of a new product, implementation of replacement of a new product cannot be happen. That will be in a stable position, sustainable position, not in a stable, sustainable position for a longer period, and definitely it incur reduced cost, which is a positive note, and perceived at a lower risk. It will be a lower risk. A quality of product which is being satisfied by me will be try to hold in for a longer period. And if I been a loyal customer, definitely I would like to purchase the same brand of for a longer period, and that would be, and no changes can be implemented. No, if I have a sufficient customers for my brand, definitely I would rather go with the low cost only. Management quality, that is competent teams, low risk, track record boost confidence. Definitely management quality in the human resources, we are the humans, are constructors and we are the destructors, because we have got three different types of resources, that is machinery, men, money. These, out of this men, machinery and money, out of these, that is machinery, money are non-living resources, men are human resources. So, living resources. So, living resources utilizes this non-living resources. The better utilization of human resource helps us for quality management. So, it is a particular, it is not I, it is a we need to work on it. So, these are the factors which also can be better decision and implementation, quality work-life management, and team building in an organization also helps us to reduction of a cost. And the last one is an economic condition. economic condition, that is what is that inflation, GDP that has been rate or that has been reflecting on a market. So economic stability is also plays, but these are all the factors which cannot be controlled, it is not completely in our hand. So it is an external factors which is cannot be controlled, but some that is how it can be that can be factors which affects the cost of whether it is an increase or a decrease. So economic stability impacts confidence definitely. If we have a local when we have a recession, definitely it hampers the organization. If it is in a boom, definitely it will be it will be having a greater impact. And the GDP, gross domestic product, definitely, and unemployment rate affects the cost. Unemployment rate is a major cost for it, and that is directly hampers the cost. And global factors as a global factors, and we have been exposed to in GDP, I mean LPG. So we have been more majorly focused and highlighted towards global international markets, and international conditions affects the market, like exchange rate, politics influence. That is, we have a good connectivity with Dubai and India, and the product which has been the government the government and our own central government and the Dubai government both has got a good the friendship with so the import and export happens between our two countries, plays a vital role. So that is how the neighboring countries will always having an effect. So other countries for import and export of goods. So all these are the factors which directly influence the cost of capital. Any factors we have to think in a major way, that is in a way that external factors cannot be controlled. So these factors always have an impact on the low cost evidence and the high cost evidence. When there is these are the factors which are highly influencing on the cost of capital. We always go with the lower to higher or higher to lower. So these are some of the concept that has been explained with regard to and factors influencing the cost of capital. So these are the concept of cost of capital and the factors influencing the cost of capital. In this regard, I would like to conclude the concept, theoretical concept, out of which there is one more concept called dividend discount model and capital asset pricing model, where this combination of explanation will be done in the next session, that is on a coming session, with the help of problems. So these are the theoretical background of a study which is being represented. So the most apt way I have been explained here on the concept which has been referred. So theoretical concept of cost of capital and the factors influencing the cost of capital has been explained, and the importance of the cost of capital, as I mentioned earlier, the most importance of the cost of capital is for deriving that is what for framing and for investment decision, for framing and dividend policy, and the opportunity that has been available for investment on both and debt and equity. These are the three important aspects that we need to consider. So they will end up the session with regard to theory explanation. Next we move on to the next session with the explanation of what does cost of debt, what does cost of equity, what the problem solving. Thank you.